Welcome and thanks for joining this investment video. I'm Ross Bramwell and member of Hamrickberg's investment team. After much anticipation, the Fed finally made its first rate cut after leaving rates at peak levels since July 2023. In this video, we'll review how market leadership has transitioned throughout this year, leading up into the rate cut announcement in mid-September, and what it could mean going forward for markets as the Fed is still trying to navigate the economy to a soft landing. Over the first half of the year, here we are on the chart in the upper left, the S&P 500 rallied 15%, which was fueled by cyclical sectors, mainly technology and communications. You'll note that we have two bars in burgundy on each chart. In addition to the S&P 500, which is cap weighted, meaning larger companies make up a larger percentage of the index. For instance, as of October 10th, just the 5 largest companies of the S&P 500 made up about 26% of the index. We also here show the S&P 500 equal weight index, which removes the bias towards the larger companies. So this chart shows that not only did just about 2 sectors outperform the S&P 500 here on the left, but it was just a handful of the largest companies that drove most of the S&P 500's return in the first half of the year. In the second chart, we highlight the third quarter of this year, during which a rotation occurred with defensive sectors such as utilities and staples outperforming, but also financials and industrials also leading the way. The S&P 500 equal weight index also outperformed the S&P 500. Here we have the S&P 500 equal weight. This was the broadening which many had anticipated would occur, where more companies were participating in the rally to new market highs, rather than just big tech. This occurred as the expectation of rate cuts increased and ultimately ended up with the first rate cut in September. This improved sentiment towards small caps, which should derive a greater benefit from lower rates. This is reflected in the S&P 500 equal weighted index outperforming the S&P 500 by 5% in Q3. In the bottom chart, we just show a brief time period, the first 2 weeks of October. This is just to highlight how quickly these trends can shift. When the Fed made its announcement for its September rate cut, markets were pricing in at least one more 0.5% rate cut before year end. In early October, that likelihood was significantly reduced and is now more likely even off the table, meaning rates will stay higher than expected for at least a little bit longer. This was due to a significantly better than expected jobs report of 258,000 new jobs added in September and some hotter than expected CPI inflation data reported last week. Big tech once again took back leadership. Even though energy, due to escalating tensions in the Middle East, and even financials outperformed, the largest companies once again had a bigger impact on the overall S&P 500 return. As you can see, the S&P 500 equal weight had underperformed during this time period. Looking forward, technology earnings growth, even though still relatively strong compared to other sectors, it has been decreasing and is expected to decrease or continue to decrease quarter over quarter. However, the same is not the case for several other S&P 500 sectors. As a result, the S&P 500 earnings growth estimates have held up due to the market rotation that has been occurring. Other sectors are expected to catch up to where technology is projected to be, which should support the broadening of market returns from just a handful of stocks. Based on consensus estimates, small cap earnings are also expected to move higher, as shown here by the S&P 600 on the far right, which should benefit broader market performance. But these are forward projections based on assumptions on consumer spending, job growth, and interest rate cuts. As of now, it appears that the Fed is on the path to a soft landing as inflation is trending down with CPI at 2.4% reported last week, and the job market is still strong. Unemployment just decreased 0.1% to 4.1%. If the Fed can continue to lower rates with the economy holding up, the broadening of the market should continue. However, if the lagged impacts of higher interest rates begin to weigh on economic growth, then investors may once again move back to big tech or the largest companies for safety. Thanks again for watching this video. If you have any further questions, please reach out to a member of your client service team.